The following presentation is provided strictly for educational and entertainment purposes only and does not constitute professional financial, legal, or insurance advice. The landscape of travel insurance is highly complex, governed by a patchwork of intricate state laws and international regulations. Because the United States regulates insurance at the state level, a policy purchased by a resident of New York may have vastly different regulatory oversight, consumer protections, and foundational definitions than a superficially identical policy purchased by a resident of Texas or Florida. Furthermore, insurance contracts are heavily dependent on individual circumstances, including age, destination, trip duration, and medical history. You must conduct your own thorough due diligence and carefully read the specific evidence of coverage or policy wording documents associated with any plan you consider. Historical trends, case studies, and past claims approvals discussed in this presentation do not guarantee future outcomes for any individual claim. Viewers are strongly advised to consult with a licensed, credentialed insurance broker or a legal professional who specializes in insurance law before executing any binding contracts, paying premiums, or making significant financial decisions regarding travel risk management. Relying solely on generalized information without reviewing the specific terms, conditions, exclusions, and limitations of a customized policy carries substantial financial risk. Now, consider a deeply unsettling reality. You are mathematically more likely to face a catastrophic, life-altering financial event while taking a 2-week international vacation than you are sitting in your own living room for an entire year. Millions of United States citizens board international flights every single day carrying nothing but their passports, a carefully planned itinerary, and a profound, dangerous delusion. They operate under the assumption that their premium travel credit card, or their comprehensive domestic health insurance policy, forms an impenetrable shield of protection around them as they cross borders. This is not just a minor misunderstanding regarding travel logistics. It is a systemic financial vulnerability that global insurance underwriters are acutely aware of, and one that travelers routinely fail to comprehend until it is far too late. Let us examine a specific, high-stakes case study that perfectly illustrates this hazard. In the winter of 2022, a 34-year-old American traveler from Ohio embarked on what was meticulously planned as a dream vacation to a remote coastal region of Southeast Asia. This individual was in peak physical health, highly organized, and had booked his entire non-refundable itinerary using a premium, high-annual fee credit card that aggressively marketed its complimentary travel protections and emergency assistance services. On the 4th day of the trip, a seemingly minor motor scooter accident on a rural road resulted in a highly complex, compound fracture of the femur and severe internal bleeding. In a fraction of a second, a leisure vacation instantly transitioned into a desperate, high-stakes fight for survival and financial solvency. The local village medical clinic completely lacked the surgical facilities, blood supply, and specialized orthopedic surgeons required to stabilize these life-threatening injuries. A specialized air ambulance was immediately necessary to transport the patient across international borders to a world-class, appropriately equipped hospital in a neighboring country. This is a terrifying scenario for anyone to face, but it is precisely the type of catastrophic event that travel insurance is supposed to handle seamlessly, correct? When the traveler's panicked family desperately contacted their domestic United States health insurance provider from a hospital waiting room halfway across the world, they were met with a cold, indisputable fact. The policy's coverage entirely ceased the exact moment the traveler left United States territory. It is a critical, frequently misunderstood reality that Medicare, Medicaid, and the vast majority of traditional employer-sponsored domestic health plans offer absolutely zero coverage in foreign jurisdictions. Panic truly setting in, the family then contacted the premium credit card company, invoking the much-advertised travel protections they believed they possessed. After hours on hold, navigating automated systems and speaking across a 12-hour time difference, the claims adjuster requested the official local police report of the accident. Because the traveler was operating a rented motor scooter, classified as a two-wheeled motorized vehicle, without possessing a specific local motorcycle endorsement stamped on his international driving permit, the credit card's insurance underwriter immediately invoked a standard, non-negotiable exclusion clause regarding the operation of motorized vehicles without proper localized licensing. The claim was denied instantly, entirely, and irrevocably. The cascading financial consequences were devastating. The family was forced to hastily liquidate their retirement accounts, incur massive early withdrawal penalties, and take out predatory emergency personal loans just to wire $145,000 directly to the foreign air ambulance company. The aviation company required this massive sum to clear international banking systems as a strict guarantee of payment before the helicopter pilot would even start the engines to retrieve the bleeding patient. The subsequent emergency surgery and multi-week hospital stay in the neighboring country added another $80,000 to the devastating total. This case study is not an isolated anomaly. It is a direct reflection of historical trends in the international medical transport sector. According to data aggregated from global medical evacuation providers, an international air ambulance routinely costs between $50,000 and $300,000, depending entirely on the geographic isolation of the patient, the required onboard medical staff, and the complexity of international flight clearances. But the most alarming aspect of this entire situation is not the staggering, life-ruining cost of foreign medical care, nor is it the physical trauma of the accident itself. The truly terrifying element is the specific, carefully drafted legal language hidden deep within the terms and conditions of almost every single travel insurance policy sold to American consumers today. There are 3 specific clauses, often buried in the dense definitions section of the contract on page 40 or 50, that act as tripwires, dictating whether a seemingly valid claim will be paid smoothly or denied entirely. I am going to reveal exactly what these clauses are, how insurance adjusters are specifically trained to look for violations of them, and the precise step-by-step strategies you can employ to ensure your claims always fall on the correct side of these rigid legal boundaries. This deep dive masterclass is designed to completely dismantle the confusion, anxiety, and misinformation surrounding travel insurance for United States citizens. Today, we are going to solve the fundamental problem of information asymmetry in the massive travel insurance market. For decades, the power dynamic has heavily favored the massive underwriters who draft incredibly dense contracts filled with opaque jargon, secondary coverage limitations, and complex pre-existing condition look-back periods. This presentation will serve as your ultimate equalizer. We will methodically explore the critical, expensive differences between standard trip cancellation coverage and the highly coveted, strictly regulated cancel for any reason upgrades. We will dissect the vital distinction between primary and secondary medical coverage, a nuanced contractual difference that could dictate whether you are forced to front tens of thousands of dollars out of pocket while waiting months for reimbursement, or if the insurance company pays the foreign hospital directly. We will analyze historical trends in trip interruption claims, examining how unpredictable geopolitical events, severe named weather patterns during hurricane season, and sudden airline strikes are handled by different tiers of coverage. Furthermore, we will break down the micro-disasters that ruin vacations, such as the cascading financial failures of a missed connection due to a mechanical issue on a domestic leg, causing you to miss a non-refundable $10,000 luxury cruise departure. By the time we conclude this comprehensive breakdown, you will possess the analytical tools necessary to evaluate a travel insurance policy with the ruthless scrutiny of a forensic auditor. You will understand exactly how to calculate the precise amount of coverage you actually need based on your specific destination's medical infrastructure, your age, and your personal risk tolerance, rather than blindly clicking accept on the heavily marked up, fundamentally flawed policies aggressively offered at the final stage of an airline booking screen. We are moving far beyond the marketing brochures and diving directly into the stark mechanics of how international travel risk is managed, mitigated, and legally transferred. Let us immediately examine the absolute foundation of any standard travel insurance policy, which is the trip cancellation and trip interruption benefit. These 2 terms are frequently used interchangeably by travelers, but from a legal underwriting perspective, they represent completely different temporal phases of your financial risk. Trip cancellation only applies to catastrophic events that occur before your scheduled departure date, forcing you to completely abandon the journey. Trip interruption conversely only activates after you have officially departed, and an unforeseen covered peril forces you to abandon the remainder of the trip and return home early. The financial stakes in both phases are astronomical, particularly in 2026, where the average cost of a 10-day international vacation for a family of 4 has surged past $15,000 due to global inflation and elevated aviation fuel costs. Imagine if you are a traveler named David, a software engineer living in Seattle, who has just spent $14,000 non-refundable dollars on a multi-generational family cruise through the Mediterranean scheduled for July of 2026. David has been meticulously planning this for 18 months. 3 weeks before the scheduled departure flight, David's elderly father, who is supposed to be on the trip, suffers a severe myocardial infarction and is hospitalized. David immediately cancels the entire trip to stay by his father's side. He assumes his standard travel insurance policy will reimburse the $14,000 because a heart attack is clearly a medical emergency. However, this is exactly where the rigid legal mechanics of the insurance contract take absolute control. When David files his claim, the insurance adjuster will immediately request his father's comprehensive medical records for the past 180 days. This specific time frame is known in the insurance industry as the pre-existing condition look-back period. The adjuster is searching for a very specific historical trend. Did David's father seek medical advice, undergo diagnostic testing, or receive a new prescription medication for any cardiovascular symptoms during that precise 180-day window prior to the exact date the insurance policy was purchased? If the medical records reveal that his father visited a cardiologist for chest pains 90 days before David bought the policy, the insurance company will classify the subsequent heart attack as a foreseeable progression of a pre-existing medical condition. The adjuster will legally deny the $14,000 claim, leaving David completely devastated financially. This brutal potential outcome could have been entirely avoided if David had understood one vital legal loophole available to United States citizens, which is the pre-existing condition waiver. When you purchase a comprehensive travel insurance policy, the vast majority of underwriters offer a strict time-sensitive window, usually between 14 and 21 days, after you make your very first trip deposit, during which you can secure a waiver that completely nullifies the look-back period. If David had purchased his policy within 2 weeks of paying the initial $500 cruise deposit, the insurance company would have been legally barred from examining his father's prior medical history, and the entire $14,000 claim would have been paid smoothly. Failing to understand this time-sensitive waiver is the single most expensive mistake travelers make when attempting to mitigate financial risk. Now let us transition to the equally complex mechanics of trip interruption. Imagine if Sarah, an architect from Denver, is 4 days into a highly anticipated $10,000 guided safari in Kenya in the fall of 2026. A severe unseasonal weather event causes massive flooding, washing out the main access roads and destroying the eco-lodge where she is supposed to stay for the next 5 nights. The tour operator officially cancels the remainder of the safari due to insurmountable logistical failures. Sarah is forced to book a sudden exorbitant one-way flight back to Denver, costing her $3,000 out of pocket, and she loses the $6,000 associated with the unused portion of the safari. She files a trip interruption claim, feeling entirely confident because severe weather is universally recognized as a covered peril. However, Sarah is about to encounter a harsh reality regarding the definition of covered perils. Her standard policy contains a specific clause stipulating that for whether to trigger a trip interruption claim, the primary accommodation must be rendered completely uninhabitable or common carrier services must be completely suspended for a minimum of 24 to 48 consecutive hours, depending on the state regulations governing her specific contract. The insurance adjuster will launch a meticulous investigation, pulling historical meteorological data and contacting local Kenyan authorities to verify the exact duration and severity of the road closures. If the tour operator canceled the trip out of extreme caution but the roads were technically passable by specialized emergency vehicles within 20 hours, the insurance company might argue that the interruption was a voluntary decision by the tour provider rather than an absolute necessity dictated by the weather event itself. In such a scenario, the claim could face severe scrutiny or outright denial, forcing Sarah into a prolonged appeals process to recover her $9,000 in combined losses. These case studies highlight a fundamental truth about standard travel insurance, which is that it functions strictly as a named peril contract. This means the policy explicitly lists the specific narrow circumstances under which it will pay a claim. Common named perils include the death, sudden severe illness or injury of the traveler, a traveling companion, or a non-traveling immediate family member. They also typically include jury duty obligations, destruction of your primary residence by fire or flood right before departure, and severe traffic accidents occurring directly en route to the departure airport. If the reason you need to cancel or interrupt your trip does not perfectly match one of these specific named perils, you have absolutely zero financial protection under a standard policy. For example, consider the historical trends we have observed in the global travel landscape. What happens if you are scheduled to fly to Paris, but 3 days before your departure, widespread civil unrest and violent protests erupt across the city? You are terrified for your personal safety and decide to cancel the trip. When you file a claim, it will be immediately denied. Fear of travel, regardless of how completely rational and justified it may be based on current events, is never a named peril in a standard travel insurance contract. Similarly, if your employer suddenly revokes your approved vacation time due to a critical staffing shortage or an emergency project deadline, your standard policy will provide zero reimbursement. Work-related cancellations are almost universally excluded, unless you are officially terminated from your job through no fault of your own after a continuous period of employment, usually defined as 1 to 3 years depending on the specific state laws. Let us examine another highly common scenario that perfectly illustrates the rigidity of named perils. Imagine if Michael, a financial analyst from Miami, is traveling to London for a highly lucrative consulting contract in 2026. His domestic flight from Miami to New York is delayed by 5 hours due to a minor mechanical issue with the aircraft doors. Because of this mechanical delay, Michael entirely misses his separate non-refundable transatlantic flight to London. He is forced to purchase a new walk-up fare at the ticket counter for $2,500. When Michael files a claim for the missed connection, his standard policy denies it. Why? Because many basic policies specify that a delay must be caused by unannounced strikes, severe weather, or a hijacked common carrier to trigger a missed connection benefit. Mechanical failures are often explicitly excluded or subject to strict minimum delay periods of 12 hours or more. Michael assumed he was protected against all airline delays, but the stark reality is that the underwriter only assumed the risk for extremely specific types of delays. This immense gap in coverage leaves millions of travelers exposed to massive financial losses due to perfectly valid yet legally excluded life events. The standard named peril contract is fundamentally insufficient for anyone who requires total control and flexibility over their travel investments. It forces consumers to gamble thousands of dollars on the hope that their emergencies perfectly align with the strict definitions written by corporate actuaries. This stark reality forces us to confront the ultimate upgrade in the travel insurance industry, a highly specific rider that completely rewrites the rules of engagement and forces the insurance underwriter to relinquish their strict control over covered reasons. It is the only mathematical way to achieve near absolute certainty in recovering your non-refundable costs, but it comes with incredibly strict purchasing windows, massive premium increases, and complex reimbursement formulas that you must understand before you ever execute a contract. But before we expose the hidden mathematics behind this ultimate policy upgrade, we must first address a much darker, far more dangerous hidden clause that insurance companies use to entirely void your medical evacuation coverage the exact moment you order a single glass of wine with your dinner. This hidden clause, deeply embedded in the exclusions section of virtually every retail travel insurance policy sold to United States citizens, is known in the actuarial world as the intoxication exclusion. You might logically assume that this clause exists solely to protect the insurance company from paying for reckless, illegal behavior, such as a traveler deciding to rent a motorcycle while heavily inebriated and crashing into a concrete barrier. However, the legal application of this exclusion is far broader and significantly more insidious. The standard policy wording typically states that no benefits will be payable for any medical expense, emergency evacuation, or accidental death and dismemberment claim, resulting in whole or in part from the insured being intoxicated or under the influence of drugs or alcohol. Notice the incredibly vague terminology. It does not stipulate that you must be legally drunk by United States driving standards. It does not state that the alcohol must be the primary, sole cause of the accident. It merely requires the insurance adjuster to establish a tenuous connection between the presence of alcohol in your bloodstream and the subsequent medical claim. Imagine if Robert, a 62-year-old retired structural engineer from Chicago, decides to take his wife on a highly anticipated 2-week culinary tour of Italy in the spring of 2026. On their third night in Rome, they enjoy a spectacular traditional dinner at a highly rated restaurant, during which Robert consumes exactly 2 glasses of premium regional wine over the course of 3 hours. He is relaxed, entirely coherent, and by all observable metrics, completely in control of his physical faculties. As they walk back to their boutique hotel, navigating a poorly lit, 2,000-year-old uneven cobblestone street, Robert catches the heel of his shoe in a deep crevice. He loses his balance, falls awkwardly, and sustains a catastrophic, highly complex compound fracture of his hip and lower femur. An Italian emergency team is immediately dispatched, and Robert is rushed to the nearest trauma center. The moment Robert is admitted, standard international medical protocol dictates that a comprehensive blood panel must be drawn before any powerful anesthetics or surgical interventions can be administered. This is a basic safety measure to ensure no adverse drug interactions occur during surgery. However, this routine blood draw also perfectly documents Robert's blood alcohol content at the exact time of hospital admission. Let us say his blood alcohol content registers at 0.04%, which is roughly half the legal driving limit in most United States jurisdictions. Robert is rushed into an emergency orthopedic surgery that costs $35,000, and the treating physician subsequently determines that Robert must be medically evacuated back to Chicago via a specialized air ambulance with an attending flight nurse, adding an astonishing $90,000 to the total medical bill. From the surgical waiting room, Robert's terrified wife dutifully calls the 24-hour emergency assistance hotline provided by their highly rated travel insurance company, completely confident that their comprehensive medical limit of $250,000 will cover this financial nightmare. The claims adjuster on the other end of the line, operating from a corporate call center in the United States, immediately opens a file and requests the official admission records and toxicology reports from the Italian hospital. This is not a secondary optional step. Requesting toxicology reports for any slip, fall, or blunt trauma injury is a mandatory hardwired standard operating procedure for international claims adjusters. When the translated medical records arrive on the adjuster's desk 48 hours later, the 0.04% blood alcohol content is instantly flagged by the internal auditing software. The insurance underwriter immediately issues a formal, legally binding denial of the entire $125,000 claim. They strictly cite the intoxication exclusion. The adjuster will legally argue that alcohol, even in moderate amounts, scientifically impairs spatial awareness, delayed reaction times, and general equilibrium. Therefore, they will assert that the 2 glasses of wine were a contributing factor to the fall. They will absolutely ignore the fact that the Roman cobblestone street was dangerously uneven, completely unlit, and objectively hazardous to a completely sober individual. Under the strict terms of the contract, the underwriter does not have to definitively prove that the alcohol was the sole, isolated cause of the accident. They only need to demonstrate that Robert was under the influence of an intoxicating substance, and that this state could have reasonably contributed to the loss. Robert and his wife are now trapped in a foreign country, facing a massive 6-figure medical debt that must be settled via international wire transfer before the hospital administrative staff will release him for the commercial flight home. This catastrophic potential outcome is a direct result of how heavily the burden of proof shifts in international insurance disputes. When a toxicology report shows any trace of alcohol, the insurance company holds the ultimate leverage. The burden entirely shifts to the traveler to legally prove a negative, specifically, to prove that the accident would have absolutely happened precisely the same way even if they had been completely sober. Achieving this requires hiring expensive foreign legal representation, securing specialized forensic engineering reports on the hazard of the street, and engaging in a multi-year legal battle with a multi-billion-dollar insurance conglomerate. Historical trends in travel insurance litigation show that the vast majority of consumers simply lack the financial resources and emotional stamina to fight these algorithmic denials, allowing the insurance companies to routinely shed massive liabilities. Let us analyze another extremely common scenario to illustrate the aggressive nature of this exclusion clause. Imagine if Jessica, a 28-year-old software developer from Austin, travels to a luxury all-inclusive resort in Cancun, Mexico, in 2026. On her second day, she is lounging by the resort pool and orders a single standard margarita. An hour later, she decides to walk back to her suite to retrieve her sunglasses. The resort staff had recently mopped the marble floor of the main lobby, but completely failed to place any highly visible wet floor warning signs in the immediate area. Jessica steps onto the slick marble, both feet fly out from under her, and she suffers a severe concussion and a fractured wrist. She is transported to a private emergency medical facility in Cancun. Just like in Robert's case, the hospital runs a standard admission blood test. Her blood alcohol content registers at 0.02%. When she files the claim for the $8,000 emergency room visit and subsequent imaging scans, the insurance adjuster applies the exact same forensic scrutiny. Despite the obvious documented gross negligence of the resort staff failing to display basic warning signs, the insurance company denies the claim based entirely on the intoxication exclusion. They argue that a perfectly sober person might have possessed the enhanced reflexes to catch themselves or visually notice the glare of the wet floor. Jessica is now legally responsible for the entire $8,000 bill, which the private Mexican hospital demands to be paid via credit card, before she is allowed to physically leave the premises. Understanding this hidden legal threat is absolutely critical for any United States citizen traveling abroad. The step-by-step strategy to mitigate this specific risk involves scrutinizing the definitions section of the policy before you ever enter your credit card information. You must actively search for policy wording that explicitly restricts the intoxication exclusion to the commission of an illegal act, such as operating a motor vehicle above the local legal limit, rather than the incredibly broad, punitive language of simply being under the influence of any substance. Furthermore, if you are ever unfortunate enough to sustain an injury after consuming any amount of alcohol, you must understand that every single word you speak to the insurance company's emergency assistance hotline is recorded and treated as a legally binding admission. If you casually volunteer the information that you had a drink with dinner before the accident, you are essentially handing the adjuster the exact verbal ammunition they need to initiate a targeted investigation into your toxicology reports. Now that we understand how a completely legal, minor action like ordering a single beverage can totally dismantle your $100,000 medical safety net, we must pivot to the offensive strategies travelers can actually deploy to regain control. We need to examine the absolute ultimate weapon consumers possess to force insurance underwriters to honor their financial commitments regardless of the circumstances or exclusions. It is time to meticulously dissect the highly coveted cancel for any reason upgrade. This specific policy rider fundamentally rewrites the entire power dynamic of travel risk management. However, simply paying the exorbitant premium for this upgrade is nowhere near enough to secure your protection. There is a deeply misunderstood, highly complex mathematical reimbursement formula built directly into the core of these cancel for any reason contracts. If you miscalculate your total insured trip cost by even one single dollar during the initial application process, the underwriter will utilize a brutal, hidden contractual mechanism to instantly downgrade your premium policy to a standard, named peril contract, completely stripping you of your upgraded protections without ever refunding a single cent of your premium money. Let us dissect exactly how this mechanism operates in the real world of 2026 travel insurance underwriting. The cancel for any reason rider, commonly referred to in the industry as CFAR, is heavily marketed as the ultimate silver bullet for travel anxiety. Consumers logically assume that by paying the steep premium surcharge, which often increases the total policy cost by 40 to 50%, they are buying absolute immunity from financial loss. The reality of potential outcomes is vastly more complicated and fraught with strict procedural landmines. The most devastating of these landmines is the absolute contractual requirement to insure 100% of your prepaid, non-refundable trip expenses. The wording in the policy contract is uncompromising. It does not say you must insure most of your trip. It dictates that every single dollar exposed to risk must be declared and insured. Imagine if Mark and Emily, a young couple from Atlanta, decide to book an elaborate $12,000 honeymoon to the Maldives for the summer of 2026. They pay a $2,000 deposit to secure an exclusive overwater bungalow, a $4,000 deposit for their international business class flights, and $6,000 directly to a luxury island tour operator. Because they are cautious, they immediately purchase a premium travel insurance policy and select the highly coveted cancel for any reason upgrade, accurately declaring their trip cost as exactly $12,000. They are now operating under the assumption that their financial exposure is completely mitigated. However, 3 weeks later, as the departure date approaches, Emily decides to surprise Mark. She contacts the resort directly and books a private, non-refundable couples spa retreat for $150 and a private sunset catamaran excursion for an additional $300. She pays for these newly added activities with her credit card, but completely forgets to log back into the travel insurance portal to officially add this new $450 of non-refundable risk to their total insured trip cost. This seemingly innocent oversight triggers a catastrophic chain reaction in the underwriting logic. Fast forward to 2 months before the scheduled departure. Mark and Emily experience a severe, unforeseen relationship crisis and make the painful decision to call off the wedding and cancel the entire honeymoon. They file a cancel for any reason claim, fully expecting the insurance company to process the paperwork and send them a check for 75% of their massive $12,000 investment. When the claims adjuster receives the file, the very first step in the historical trends of CFAR auditing is a forensic reconciliation of all trip expenses. The adjuster legally demands every single vendor invoice, airline receipt, and corresponding credit card statement to verify the exact scope of the financial loss. When the adjuster reviews Emily's credit card statement, they spot the charges for the spa and the catamaran. They calculate the true, total non-refundable cost of the trip to be $12,450. Because Mark and Emily only insured $12,000, they have fundamentally violated the core contractual requirement of the cancel for any reason rider. The insurance underwriter does not simply issue a prorated refund. They do not just ignore the extra $450. Instead, the underwriter utilizes that specific contractual mechanism to instantly void the CFAR benefit entirely. The policy automatically and legally reverts to a standard, basic named peril contract. Because a broken engagement or a personal relationship crisis is never listed as a covered named peril in any standard travel insurance policy, the entire claim is instantly denied. Mark and Emily lose all $12,450 because of a mathematical discrepancy representing less than 4% of their total trip cost. The insurance company keeps the massive premium they paid for the upgrade, and the travelers are left with absolutely nothing. This brutal potential outcome demonstrates exactly why you must relentlessly update your policy every single time you add a non-refundable expense to your itinerary, right up until the day of departure. If you manage to successfully navigate the mathematics of your total trip cost, you must then confront the rigid chronological boundaries of the CFAR rider. You cannot simply decide to cancel your trip while you are standing in the chaotic security line at the departure airport or sitting in an Uber on the way to the terminal. The vast majority of comprehensive policies dictate that you must formally initiate the cancellation process with both your travel suppliers and the insurance provider no later than 48 hours prior to your originally scheduled departure time. Let us examine another critical case study. Imagine if James, a senior executive living in Boston, has meticulously planned an $8,000 golf expedition to Scotland for September of 2026. He holds a flawless cancel for any reason policy and has accurately insured every single penny of his non-refundable costs. 36 hours before his transatlantic flight is scheduled to depart, he receives a frantic phone call. His firm's largest corporate client is threatening to terminate their massive contract due to an unforeseen supply chain crisis. James instantly realizes that he cannot board an international flight and be completely unreachable while his professional career is imploding. He decides he must stay in Boston to salvage the account. He immediately calls his travel insurance emergency hotline to cancel his trip and invoke his CFAR benefit, fully expecting to recover $6,000 based on his 75% reimbursement tier. The claims adjuster looks at the timestamp of the phone call, compares it to the scheduled departure time on James's airline ticket, and immediately denies the cancel for any reason claim. Because James crossed the mandatory 48-hour threshold by a mere 12 hours, the CFAR rider is completely dead and legally unenforceable. Just like in the previous scenario, James's policy instantly drops down to a standard named peril contract. Because a sudden catastrophic work obligation or a client emergency is almost universally excluded from standard trip cancellation coverage, James is completely unprotected. He loses his entire $8,000 investment simply because the crisis occurred inside that final 2-day window. The insurance underwriters strategically implement this 48-hour rule specifically to prevent travelers from canceling at the absolute last minute due to minor inconveniences, slightly bad weather forecasts that do not meet the definition of a severe storm, or sudden buyer's remorse. Furthermore, the financial reality of the reimbursement itself is deeply misunderstood by the traveling public. It is mathematically impossible to be made completely whole using a cancel for any reason claim. If you invoke this specific rider, the industry standard payout structure only reimburses between 50 and 75% of your total insured non-refundable costs, depending entirely on the specific premium tier you purchased. You are essentially paying a massive upfront premium surcharge for the specific privilege of voluntarily accepting a 25 to 50% financial loss. You are buying flexibility, not total indemnification. You are buying the right to simply wake up one morning, decide you do not feel like dealing with the hassle of international airports, and walk away with a significant portion of your money intact. But while cancel for any reason policies protect you from your own changes of heart and personal emergencies prior to departure, there is an entirely different, highly complex financial threat looming over the global travel industry in 2026. What happens when the disaster strikes not because of your own circumstances, but because the massive corporation you paid to transport you suddenly ceases to exist? You might assume that if an airline abruptly shuts down operations and strands you midway through your journey, your premium travel credit card chargeback rights, or your standard travel insurance will automatically save you. However, there is a specific, legally terrifying chronological loophole embedded deeply within federal consumer protection laws and standard insurance exclusions that airline bankruptcy lawyers routinely exploit to legally freeze your assets and deny your refunds for years. This specific legal threat is formally classified within the insurance industry as the financial default or supplier bankruptcy exclusion, and it represents one of the most devastating blind spots for the modern international traveler. When a major common carrier, cruise line, or massive international tour operator abruptly ceases operations due to insolvency, they immediately file for legal bankruptcy protection. The exact second that legal filing is stamped by a judge, an impenetrable corporate shield is erected around the remaining assets of that company. As a traveler holding a prepaid non-refundable ticket, you are legally reclassified by the bankruptcy court as an unsecured creditor. You are placed at the absolute bottom of a massive multi-billion-dollar priority list, standing hopelessly in line behind secured corporate bondholders, highly aggressive aircraft leasing syndicates, domestic tax authorities, and thousands of unpaid employees. The mathematical reality and historical trends of corporate liquidations dictate that unsecured ticket holders rarely recover more than a few pennies on the dollar, and those microscopic payouts often take 3 to 5 years of agonizing litigation to materialize. The vast majority of United States citizens operate under the dangerous assumption that federal consumer protection laws, specifically the Fair Credit Billing Act, will automatically rescue them. They believe they can simply call their premium credit card issuer, initiate a standard chargeback for services not rendered, and see the funds return to their account within days. This is a terrifying misconception based on a fundamental misunderstanding of chronological legal limits. The Fair Credit Billing Act generally mandates that a consumer must dispute a charge within 60 days of the statement date on which the charge originally appeared. While many premium credit card issuers voluntarily extend this window as a courtesy for future travel, they are not legally obligated to do so when facing a multi-million-dollar wave of chargebacks from a collapsed airline. Imagine if Thomas, a high school principal from Chicago, decides to book a spectacular $10,000 retirement cruise through the Norwegian fjords. In January of 2026, he pays the entire $10,000 balance upfront to secure a massive early booking discount for a voyage departing in late September of 2026. Thomas uses his favorite travel rewards credit card and assumes he is financially bulletproof. 8 months later, in late August, the boutique cruise line suffers a catastrophic liquidity crisis and immediately halts all global operations, stranding thousands of passengers. Thomas immediately calls his credit card company to initiate a chargeback. However, the bank's dispute resolution department informs him that because the original transaction posted to his statement more than 200 days ago, the mandatory federal protection window has long since expired. The bank, unwilling to absorb the massive loss on behalf of the bankrupt cruise line, legally denies the dispute. Thomas's $10,000 are now permanently trapped in a foreign bankruptcy proceeding, completely inaccessible. This scenario forces travelers to turn to their comprehensive travel insurance policies, only to discover yet another layer of incredibly rigid contractual stipulations. Financial default is almost never covered by default in a basic entry-level travel insurance policy. It is highly specific protection that requires exact chronological compliance to activate. To successfully secure coverage against the bankruptcy of a travel supplier, the policyholder must almost universally purchase the travel insurance contract within a strict time-sensitive window, typically 14 to 21 days from the date they made their very first initial deposit toward the trip. If Thomas had waited until 30 days after booking his cruise to purchase his insurance, the underwriter would permanently exclude any protection against the cruise line going out of business. Furthermore, even if you purchase the policy on the exact day you booked the trip, underwriters deploy a secondary defensive mechanism known as the waiting period. Standard policy language explicitly dictates that the travel supplier must financially default a minimum of 10 to 14 days after the policy takes effect. This prevents travelers who read a negative news article about an airline's impending financial collapse from suddenly buying a policy on Tuesday to cover a bankruptcy filing on Thursday. The insurance companies employ massive teams of risk analysts who constantly monitor the financial health of global airlines and cruise operators. If an underwriter determines that a specific airline is teetering on the edge of insolvency, they will quietly update their internal underwriting guidelines and completely remove that specific airline from their list of covered suppliers for any new policies moving forward. Let us explore an even more deceptive trap related to supplier bankruptcy, known as the affiliated entity exclusion. Imagine if Rachel, a graphic designer from Miami, books a $5,000 vacation package directly through a large, well-known online travel agency in 2026. During the online checkout process, she clicks a highly visible button to add the travel agency's highly recommended, white-labeled travel insurance policy for an extra $300. She completes the purchase, feeling entirely secure. 3 months later, the online travel agency itself files for bankruptcy, taking Rachel's $5,000 with them. When Rachel contacts the insurance underwriter that provided the policy, the adjuster points to a specific clause buried in the definitions section. The clause states that the policy absolutely excludes coverage for the financial default of any person, agency, or tour operator from whom the insured purchased the travel arrangements or the policy itself. Because Rachel bought the insurance directly from the exact entity that subsequently went bankrupt, her coverage is instantly voided. You must always purchase your travel insurance from an independent, third-party brokerage to establish a legally protective firewall between the company holding your travel funds and the company holding your risk. Understanding the severe chronological and procedural hurdles of financial default coverage is vital for protecting your pre-trip financial investments, but it pales in comparison to the terrifying realities of an active medical crisis in a foreign jurisdiction. Once you actually board the aircraft and cross international borders, the financial risks transition from frustrating logistical losses to potentially life-ruining medical debts. The global healthcare system does not operate on goodwill, and foreign hospital administrators view uninsured international tourists as massive financial liabilities. To survive this landscape, you must understand a deeply consequential distinction hidden in the medical evacuation clauses of your policy. It is a distinction that dictates who actually controls your medical destiny when you are unconscious in a foreign trauma center. Next, we must expose the terrifying difference between primary and secondary medical coverage and reveal the exact, horrifying moment a foreign hospital administrator demands your physical passport as collateral before they will even authorize the administration of basic pain medication. The reality of international healthcare is brutally transactional and operates entirely outside the boundaries of the Emergency Medical Treatment and Labor Act that protects patients within the United States. When you arrive at an emergency room in a foreign country, particularly in developing nations or highly privatized healthcare systems, the administrative staff views you primarily as a massive unsecured financial liability. They know with absolute certainty that once you recover and board an international flight back to your home country, they possess zero legal jurisdiction or realistic mechanism to collect an unpaid medical debt. Consequently, historical trends dictate that foreign hospitals deploy extremely aggressive financial compliance tactics the exact moment you walk through their doors. Before they even consider hooking up an intravenous drip or authorizing a highly necessary computed tomography scan, they will demand a direct verifiable guarantee of payment. If you cannot produce this immediately, they will literally demand your physical United States passport, locking it in an administrative safe to ensure you cannot legally flee the country until the total hospital bill is settled in full. This terrifying scenario perfectly illustrates the catastrophic financial difference between purchasing a policy with primary medical coverage versus one with secondary medical coverage. Millions of travelers simply look at the total coverage limit, perhaps seeing a respectable $100,000 medical maximum, and falsely assume they are completely protected from any financial ruin. They completely fail to read the microscopic print determining whether that specific coverage tier is primary or secondary. Let us examine a deeply instructive case study set in 2026. Imagine if Daniel, a 45-year-old marketing executive from Dallas, is on a highly anticipated ski vacation in the French Alps. On his second day, he suffers a severe compound fracture of his lower leg on the slopes, requiring immediate helicopter extraction off the mountain and complex orthopedic surgery at a private alpine clinic. The total estimated cost for the mountain extraction, the emergency surgery, and a required 5-day hospital stay is approximately $45,000. Daniel feels a brief wave of relief because he knows he purchased a travel insurance policy with a $50,000 medical limit. However, from his hospital bed, when he calls his travel insurance provider, he discovers his policy is strictly secondary. This single contractual detail triggers a cascading financial nightmare. Secondary medical coverage legally mandates that the travel insurance company is the payer of last resort. The claims adjuster explicitly informs Daniel that he must first pay the entire $45,000 bill completely out of pocket to the French clinic. Alternatively, he must first file a complex international claim with his domestic United States health insurance provider, endure their agonizingly slow overseas claims process, wait for an official written denial known in the industry as an explanation of benefits, and only then submit that formal denial document back to the travel insurance company for reimbursement consideration. The private French clinic is completely uninterested in Daniel waiting 3 months for a domestic insurance denial. They demand the $45,000 immediately before they will schedule the orthopedic surgeon. Daniel is forced to frantically max out 3 different personal credit cards, incur massive foreign transaction fees, and completely drain his liquid emergency savings just to facilitate his own necessary surgery and secure the release of his passport from the hospital administrators. For the next 6 months, Daniel is trapped in an administrative purgatory, fighting a multi-front war against his domestic health insurance, his travel insurance provider, and accruing thousands of dollars in high-interest credit card debt, all because he saved perhaps $20 on his initial policy premium by unknowingly selecting a secondary coverage plan. Now contrast this severe potential outcome with the absolute mechanics of primary medical coverage. Imagine if Jessica, a 32-year-old graphic designer from Seattle, experiences a massive sudden appendicitis attack while navigating the remote regions of Patagonia in 2026. She is rushed to a local private hospital requiring an emergency appendectomy costing $18,000. Jessica was highly educated on the nuances of underwriting and intentionally purchased a premium policy featuring primary medical coverage. When she calls her travel insurance emergency assistance hotline, the process is radically and beautifully different. Because her coverage is primary, the travel insurance company completely bypasses her domestic United States health insurance. They open a direct line of communication with the billing department of the Patagonian hospital. Within a matter of hours, the insurance underwriter issues a formal legally binding guarantee of payment directly to the foreign medical facility. This specific document legally assures the hospital that the multi-billion-dollar insurance conglomerate will pay the $18,000 bill directly via international wire transfer. The hospital immediately proceeds with the surgery. Jessica does not have to hand over a single credit card. She does not drain her retirement savings. Her passport remains securely in her possession, and she faces absolutely zero out-of-pocket expenses. Primary medical coverage acts as an impenetrable financial shield, instantly transferring the immense burden of international medical billing directly to the underwriter. It is an absolute non-negotiable requirement for any traveler who does not possess $50,000 of liquid cash readily available to float an international medical crisis. However, even if you successfully secure primary medical coverage, you are still legally bound by the most restrictive and heavily litigated clause in the entire travel insurance industry, which is the medical evacuation protocol. Travelers possess a deeply dangerous misconception that if they are severely injured abroad, their travel insurance will automatically dispatch a private luxury medical jet to fly them directly back to their preferred local hospital in the United States. This is almost never how standard medical evacuation clauses function in reality. The specific legally binding language in 99% of retail policies states that the insurance company will solely pay to transport you to the nearest adequate medical facility capable of treating your specific condition. Notice the immense legal weight bearing down on the word adequate. You do not get to define what is adequate. Your panicked family members do not get to define what is adequate. That critical definition is entirely controlled by the attending foreign physician and the insurance company's internal chief medical director sitting in a corporate office back in the United States. Imagine if you suffer a severe cardiac event in a developing nation. You are stabilized at a local public hospital that lacks air conditioning, has severely outdated diagnostic equipment, and suffers from chronic severe nursing shortages. You immediately demand to be medically evacuated to a world-class cardiac center in Houston, Texas. The insurance company's medical director reviews your chart and determines that the local public hospital technically possesses the basic surgical capacity to perform a bypass, regardless of the facility's overall comfort, aesthetic condition, or long-term survival statistics. The insurance company will formally declare the facility adequate and legally deny your $200,000 air ambulance request. You are now entirely trapped. You are medically stabilized but incredibly vulnerable in a foreign facility you deeply distrust, and the insurance company has legally fulfilled their strict contractual obligation to get you to an adequate level of care. They have absolutely zero obligation to fly you home simply because you prefer the comforts and standards of your local American healthcare system. This terrifying standoff happens to American travelers every single week across the globe. It forces us to confront the absolute darkest reality of the travel insurance ecosystem. What exactly are the precise step-by-step escalation tactics you must deploy when the insurance company's corporate medical director completely overrides the severe warnings of the local foreign doctor? We must urgently dissect the specific legal definition of medical necessity, how corporate actuaries weaponize this exact phrase to deny life-saving transportation, and the incredibly specific medical documentation you must legally force the foreign hospital to produce to break the underwriter's resistance and secure that multi-million-dollar medical flight. To understand this battlefield, you must first recognize that the phrase medical necessity is not a universal clinical standard. It is a highly subjective, legally weaponized definition engineered by corporate actuaries to aggressively minimize their financial exposure. The insurance company's medical director, sitting in a comfortable corporate office in the United States, is analyzing a translated spreadsheet of vital signs. They are not standing beside your hospital bed witnessing the unsanitary conditions, the severe lack of specialized nursing staff, or the archaic diagnostic equipment. If their baseline algorithm determines that your heart rate is artificially stabilized by intravenous medication, they will aggressively argue that you are entirely fit to remain in that substandard facility until you naturally recover enough to board a standard commercial flight home weeks later. Imagine if Michael, a 55-year-old high school chemistry teacher from Chicago, is trekking in a remote mountainous region of Peru in 2026. He suffers a massive, sudden hemorrhagic stroke. He is rushed down the mountain to a small rural clinic. The clinic physicians miraculously manage to stabilize his immediate vital signs using basic medications, but the facility completely lacks a specialized neurosurgical intensive care unit, a dedicated stroke team, or advanced magnetic resonance imaging machines. Michael's wife frantically contacts their travel insurance emergency hotline, demanding an immediate $150,000 specialized air ambulance transfer to a world-class neurological center in Miami. The corporate medical director back in the United States reviews the basic chart, notes that Michael is currently breathing independently, and formally declares the rural Peruvian clinic completely adequate for basic stabilization. The evacuation claim is instantly and aggressively denied. This is the exact moment where passive travelers lose their lives or their life savings, and where educated travelers deploy specific, uncompromising escalation tactics. Michael's wife must not waste a single second arguing with the frontline call center representative. She must immediately demand a formal peer-to-peer review between the local attending physician in Peru and the insurance company's chief medical officer. But more importantly, she must legally force the local Peruvian doctor to draft a highly specific, aggressively worded clinical summary. This document cannot simply state that the patient requires better care or would be more comfortable elsewhere. Those phrases are legally meaningless to an underwriter. The documentation must explicitly state in undeniable medical terminology that the current facility entirely lacks the specific life-saving surgical expertise and advanced diagnostic equipment required to prevent imminent loss of life or permanent severe neurological impairment. The written medical report must contain the exact trigger phrases that legally corner the underwriter. The attending physician must document in writing that keeping the patient at the current facility constitutes an active, critical threat to their survival, and that immediate specialized extraction is an absolute medical necessity to prevent a catastrophic physiological outcome. Historical trends in international claims litigation reveal that underwriters deny initial medical evacuation requests at a staggering rate simply because the initial medical report provided by the foreign hospital is too vague or overly optimistic. The burden of proof is thrust entirely upon the traveler to mathematically and medically prove that the local facility is fundamentally incapable of preventing their death. Once that specific, highly aggressive documentation is formally submitted to the corporate medical director, the legal liability completely shifts. If the underwriter denies the flight after receiving written confirmation from the local doctor that the patient will die without specialized transport, the insurance company opens itself up to massive, multi-million-dollar wrongful death lawsuits. That is exactly how you break their resistance and force the deployment of the medical jet. However, what if you simply refuse to participate in this terrifying bureaucratic nightmare while your loved one is fighting for their life? What if you want to completely bypass the entire subjective debate over what constitutes an adequate medical facility? This brings us to the absolute holy grail of travel insurance upgrades, a specific policy rider designed exclusively for travelers who demand total, uncompromising control over their healthcare geography. This highly coveted upgrade is formally known as the Hospital of Choice Rider, or occasionally marketed as a medical evacuation to home hospital benefit. This rider entirely strips the insurance company of their power to dump you at the nearest acceptable clinic. Let us examine exactly how this premium upgrade functions in the real world. Imagine if Sarah, a 42-year-old commercial airline pilot from Phoenix, is involved in a severe multi-vehicle collision while driving a rental car through rural Thailand in 2026. She sustains multiple complex fractures to her pelvis and lower extremities. She is transported to a highly respected, modern hospital in Chiang Mai. The facility is objectively excellent, fully equipped with state-of-the-art orthopedic surgical suites and world-class trauma surgeons. By every single metric utilized by corporate actuaries, this Thai hospital is perfectly adequate. Under a standard comprehensive travel insurance policy, the underwriter would gladly pay for her surgeries, but they would absolutely refuse to fly her back to the United States. They would legally force Sarah to remain in Thailand for 6 to 8 weeks to undergo physical therapy, until she could physically tolerate sitting upright in a commercial airline seat. But Sarah specifically purchased a premium policy featuring a hospital of choice rider. This specific legal contract dictates that if she is hospitalized internationally for an explicitly defined number of days, usually ranging from 3 to 7 consecutive days depending on the underwriter, she acquires the absolute contractual right to demand immediate transportation back to her primary home hospital in the United States. It completely ceases to matter whether the Thai hospital is a world-class facility or a rural clinic. Once she is medically stabilized enough to survive a transatlantic flight, the insurance company has absolutely zero legal standing to keep her in Asia. Sarah simply invokes her hospital of choice benefit, and the underwriter is legally obligated to charter a private long-range medical jet, fully staff it with specialized flight nurses and a critical care physician, and transport her directly from the tarmac in Thailand back to her preferred specialized orthopedic rehabilitation center in Phoenix, Arizona. This singular upgrade eliminates the terrifying variable of foreign medical confinement and ensures you always recover on your own terms, in your own country, surrounded by your own domestic healthcare network. But while securing your medical evacuation and mastering the intricacies of international healthcare is the ultimate physical safeguard, there is a completely different, purely financial disaster that bankrupts thousands of American travelers every single year. It involves the highly deceptive, mathematically rigged world of rental car insurance overseas. You might operate under the deeply comforting assumption that your premium, high annual fee travel credit card completely covers your international rental vehicle against any physical damage or loss. You rely on their heavily advertised collision damage waiver benefits. But there are exactly 4 specific, highly popular international destinations where your credit card's multi-billion-dollar underwriter absolutely and legally voids your entire coverage the exact second you drive the vehicle off the rental lot, leaving you completely and personally liable for massive total vehicle replacement costs and catastrophic third-party liability claims. Let us immediately identify these 4 specific jurisdictions that represent massive financial traps for United States citizens. Based on historical trends and the foundational underwriting guidelines of almost every major premium travel credit card issued in America, those exact 4 countries are the Republic of Ireland, Israel, Italy, and Jamaica. When you carefully examine the microscopic print of your credit card benefits guide, you will find a highly specific geographic exclusion clause completely isolating these nations. The insurance underwriters have mathematically determined that the unique combination of narrow rural road infrastructures, distinct local driving cultures, and highly aggressive domestic insurance regulations in these 4 specific regions creates a risk profile that is simply too catastrophic for them to subsidize. Imagine if David, a 35-year-old architect from Austin, Texas, travels to the Republic of Ireland in 2026. He arrives at the car rental counter in Dublin and confidently hands over his premium travel credit card. The local rental agent strongly advises him to purchase the localized daily collision damage waiver, warning him about the extremely narrow, winding roads lined with ancient stone walls. David firmly declines the local coverage, operating under the dangerous assumption that his expensive credit card provides an impenetrable shield of primary rental car protection. 3 days later, while navigating a rural road in County Kerry, David sideswipes a concealed stone barrier, causing severe structural damage to the passenger side of his rented compact sport utility vehicle. David is completely unbothered. He returns the heavily damaged vehicle, fills out a brief incident report, and boards his flight back to Texas, assuming his credit card company will seamlessly handle the paperwork. 2 weeks later, David logs into his online banking portal, and discovers a staggering $32,000 charge pending on his credit card account. The Irish rental agency instantly charged him for the entire replacement value of the damaged vehicle. When David frantically initiates a collision damage waiver claim with his credit card underwriter, the adjuster immediately pulls the police report, identifies the geographic location of the accident, and strictly cites the geographic exclusion clause. The claim is legally denied in a matter of minutes. Because David entirely bypassed the local insurance and relied on a voided credit card benefit, he is now personally and legally responsible for a $32,000 debt. However, even if you are renting a vehicle in a country that is entirely covered by your credit card, you remain severely exposed to two deeply hidden, highly predatory fees that international rental agencies routinely weaponize against American travelers. The first of these hidden financial threats is formally known as a loss of use charge. Let us thoroughly examine the brutal mechanics of this fee. If you accidentally dent the bumper of a rental vehicle in France, that specific car must be completely removed from the active, revenue-generating rental fleet to undergo professional repairs. The foreign rental agency will mathematically calculate the exact daily rental rate they are losing while that vehicle sits idle in the body shop. If the repairs require 21 days to complete, and the vehicle typically rents for $150 a day, the agency will aggressively bill you an additional $3,150 strictly for the lost revenue. You might assume your credit card insurance will cover this specific loss of use penalty, but this is a massive procedural trap. Many credit card insurance policies explicitly exclude loss of use charges entirely. Even those premium policies that technically offer the benefit will deploy a rigid defensive mechanism. The claims adjuster will legally demand that the foreign rental agency produce highly specific, highly confidential internal fleet utilization logs to mathematically prove that they actually suffered a financial loss. The insurance company requires proof that the rental agency had absolutely zero other identical vehicles available to rent to other customers on those specific days. International rental agencies notoriously and aggressively refuse to provide these internal proprietary utilization logs to third-party American insurance companies. This creates an intentional, inescapable administrative stalemate where the insurance company legally refuses to pay without the logs, the rental agency completely refuses to provide the logs, and you, the consumer, are ultimately forced to pay the massive $3,000 loss of use penalty entirely out of pocket to avoid international collection agencies. The second catastrophic hidden fee is known in the actuarial world as diminution of value. Once a rental vehicle has been involved in any documented physical accident, its total long-term resale value permanently plummets. International rental agencies rely heavily on selling their massive fleets on the secondary used car market after a specific mileage threshold is reached. An accident clearly marked on the vehicle's historical reporting completely destroys that lucrative resale value. If you cause $6,000 of physical body damage to a $40,000 luxury sedan, the rental agency will certainly repair the vehicle, but they will also mathematically calculate that the car is now only worth $30,000 on the open market strictly due to its new accident history. They will aggressively pursue you for that $10,000 permanent depreciation gap. The vast majority of credit card collision damage waivers provide absolutely zero protection against diminution of value claims, leaving you financially devastated, even if the actual physical repair costs were fully covered by your policy. But the absolute ultimate financial blind spot in international vehicle rentals is the terrifying reality of third-party liability. Imagine if Robert, a 50-year-old small business owner from Ohio, travels to Germany in 2026 and rents a premium luxury sports sedan to drive on the legendary Autobahn network. He meticulously uses his top-tier travel credit card, which correctly and fully provides primary collision damage waiver coverage within the borders of Germany. While navigating a highly complex, multi-lane intersection in central Munich, Robert momentarily misjudges a local right-of-way and collides heavily with a commercial delivery van. The impact severely injures the local German delivery driver and completely destroys the commercial van. Robert is completely unharmed physically, and his credit card insurance flawlessly pays the $65,000 replacement cost for his destroyed rental sports sedan. Robert falsely believes he has completely survived the financial crisis. However, 4 months later, Robert receives a massive international legal summons delivered directly to his home in Ohio. The German delivery driver is legally suing him for $250,000 to cover extensive medical rehabilitation, lost wages, and permanent physical disability. Simultaneously, The German delivery corporation is suing him for $50,000 to completely replace their destroyed commercial van and its ruined cargo. Robert frantically contacts his credit card company, demanding that they deploy a legal team to defend him and settle the massive international lawsuit. The claims adjuster informs Robert of a terrifying, non-negotiable reality. Credit card travel insurance exclusively covers physical damage to the actual rental vehicle you are physically driving. It provides absolutely zero third-party liability coverage. It will not pay a single cent for the catastrophic physical damage you cause to other human beings, to other private vehicles, or to municipal infrastructure. Furthermore, your standard domestic United States auto insurance policy almost never extends its liability coverage across international borders. Robert is now facing a massive, life-altering $300,000 international lawsuit with absolutely zero financial shielding, completely vulnerable to asset seizure and domestic bankruptcy. This terrifying reality completely forces travelers to completely rethink how they protect their physical assets while traveling internationally. But the danger does not stop at the rental car counter. What happens when you safely park that completely insured vehicle, but a thief shatters the window and completely steals your $10,000 camera bag, holding your professional photography equipment and your customized laptop? You might feel a false sense of security knowing you have a baggage and personal effects benefit built into your comprehensive travel insurance policy. But you are about to encounter the most brutal, mathematically ruthless concept in the entire insurance industry: the actual cash value depreciation schedule. We must now completely expose exactly how corporate adjusters legally use aggressive depreciation formulas to look at your stolen $3,000 laptop and mail you a completely insulting check for $300, and the highly specific documentation you must possess to fight back. The foundational misunderstanding regarding personal effects coverage stems from a critical difference between two specific insurance terms known as replacement cost and actual cash value. When you look at your travel insurance policy summary and see a $2,500 maximum benefit for lost or stolen baggage, you naturally assume that if your $3,000 laptop is stolen, you will receive a check for $2,500. You assume the insurance company will help you replace the item you lost, so you can resume your professional or personal life. However, historical trends in the travel insurance industry dictate that retail policies almost never pay replacement cost. They strictly utilize actual cash value, which is an aggressive actuarial formula designed to calculate exactly what your used, outdated electronic device was worth on the open market the exact second before it was stolen. Imagine if Emily, a 29-year-old digital marketing consultant from Denver, is traveling by high-speed rail from Madrid to Barcelona in the summer of 2026. She briefly places her custom photography backpack on the overhead luggage rack directly above her seat. Inside that backpack is a premium laptop she purchased exactly 3 years ago for $3,000, a digital mirrorless camera she bought 2 years ago for $2,000, and noise-canceling headphones worth $400. Exhausted from her travels, Emily falls asleep for 20 minutes. When she wakes up, the backpack is entirely gone, stolen by highly organized transit thieves who operate seamlessly on European rail networks. Emily is devastated but feels a profound sense of relief because her premium comprehensive travel insurance policy explicitly states she has $3,000 in total baggage coverage. She immediately files a claim, expecting a check that will allow her to walk into a retail store in Barcelona and purchase replacement equipment. Weeks later, the claims adjuster reviews her file and applies the brutal actual cash value depreciation schedule. The adjuster notes that the laptop is 3 years old. In the actuarial world of consumer electronics, a laptop depreciates at a staggering rate of roughly 20 to 30% per year. The corporate software calculates that Emily's heavily used 3-year-old laptop is no longer worth $3,000, but rather has a current actual cash value of perhaps $600. The 2-year-old camera is depreciated down to $800. The headphones are depreciated to $100. Her massive $5,400 loss is instantly mathematically reduced to a maximum payable baseline of just $1,500. But the financial devastation does not end with simple depreciation. Emily is about to collide with the second highly aggressive defensive mechanism, hidden deep within the baggage coverage fine print, a clause known as the per-item limit. The marketing brochure boldly advertises $3,000 of total coverage, but buried on page 30 of the legally binding policy document is a microscopic stipulation stating the maximum payout for any single individual item is strictly capped at $500. Therefore, Even though her depreciated laptop is technically calculated to be worth $600, the per-item limit instantly caps her reimbursement for that specific device at $500. The depreciated $800 camera is similarly capped at $500. Furthermore, underwriters deploy a third layer of mathematical restriction, known as the specific category limit. Electronics, jewelry, watches, and specialized sporting equipment are universally classified as high theft risk items. The policy will almost always dictate a combined maximum limit for all items falling into these high-risk categories, frequently capping the entire category at $500 or $1,000 total for the entire trip. Because both the laptop and the camera fall under the electronics category, Emily's maximum potential payout for both items combined is strictly halted at that specific category limit. After enduring a horrific theft and navigating a highly complex international claims process, Emily's expected multi-thousand-dollar reimbursement is mathematically shredded down to a few $100s, entirely legally, strictly based on the terms she unknowingly agreed to when purchasing the policy. Even if Emily mathematically accepts this minuscule payout, she must still survive the rigorous burden of proof demanded by the claims adjuster. Travel insurance companies will absolutely never take your word regarding what was inside your stolen bag. To successfully process even a severely depreciated claim, you must produce the original purchase receipts for every single stolen item to definitively prove ownership and establish the exact date of purchase for their depreciation software. If you cannot produce a 3-year-old digital receipt for your laptop, the claim for that item is instantly denied. Additionally, you must produce an official, translated police report filed within exactly 24 hours of the theft. If you wait 48 hours to report the crime because you were entirely focused on canceling your compromised credit cards and securing a new passport, the underwriter will strictly cite the delayed reporting exclusion and deny the entire claim. The most terrifying exclusion utilized to deny personal effects claims is the unattended baggage clause. Insurance companies require you to exercise reasonable care to protect your property. If the claims adjuster reads the Spanish police report and discovers that Emily fell asleep on the train while her bag was on the overhead rack, the adjuster will formally classify the bag as unattended. The underwriter will legally argue that falling asleep in a public transit environment constitutes gross negligence and a failure to secure personal property. The entire claim will be instantly denied on the grounds of traveler negligence. This exact same exclusion applies if you leave your locked luggage in the trunk of a rental car overnight, or if you place your backpack on the floor under your table at a busy outdoor cafe and look away for 30 seconds. If the item is not physically attached to your body or locked inside a highly secure hotel safe, the insurance company possesses the legal leverage to argue it was unattended. The ultimate strategic solution to this massive coverage gap is completely bypassing travel insurance for your high-value items. Educated travelers in 2026 rely entirely on highly specialized inland marine policies or scheduled personal property endorsements attached directly to their domestic United States homeowner or renter insurance policies. These specialized domestic policies provide absolute worldwide coverage, they zero out the deductible, and most importantly, they explicitly pay the true replacement cost without applying those brutal depreciation formulas or punishing per item limits. You must entirely separate the risk of your physical health and trip cancellation from the risk of your physical property. Now that we have completely dismantled the mathematical illusions of baggage coverage, we must confront the final, absolute worst-case scenario a traveler can face. You have purchased the perfect primary medical policy, you hold a flawless cancel for any reason upgrade, and you have secured the hospital of choice rider. But when the massive disaster strikes and you are standing in a foreign hospital or a chaotic airport, the very first phone call you make to the insurance company's emergency assistance hotline will entirely dictate whether you are financially saved or completely ruined. There is one specific, highly common, perfectly natural phrase that panicked Americans instinctively say to the emergency operator that instantly permanently blacklists their file and gives the corporate legal department the exact verbal ammunition they need to legally deny every single subsequent claim you file. We must now dissect the psychology of the emergency assistance phone call and outline the exact script you must rigidly follow to force the underwriter to pay. The moment you dial that toll-free international number printed on the back of your insurance card, you are no longer just a terrified traveler seeking comfort and logistical support. You are immediately entering a highly recorded, legally binding verbal deposition with a massive financial institution whose primary fiduciary duty is to strictly limit their monetary exposure. The person answering the phone may sound incredibly empathetic, speaking with a calm, reassuring voice, but you must understand their actual operational role. They are not medical professionals, they are not your personal advocates, and they are not there to simply open their checkbook. They are highly trained intake coordinators utilizing sophisticated algorithmic prompt screens designed to extract extremely specific, disqualifying information from you during your most vulnerable, adrenaline-fueled moments. When they ask the seemingly innocent question of how the accident happened or if you have ever experienced anything like this before, they are actively hunting for verbal admissions that trigger standard policy exclusions. Imagine if William, a 50-year-old project manager from Denver, is traveling through the rural highlands of Scotland in 2026. While navigating a steep, muddy hiking trail, he violently twists his knee, feeling a catastrophic pop that renders him completely unable to walk. He manages to get cell service and calls his premium travel insurance emergency hotline, while waiting in agony for a local rescue team. Seeking empathy and attempting to explain the severity of the situation, William voluntarily tells the operator that he slipped on the mud, adding that it is incredibly frustrating because he had minor arthroscopic surgery on that exact same knee 10 years ago, but it had been perfectly fine ever since. That single offhand comment, spoken while shivering on a hillside, instantly destroys his entire medical claim. The intake coordinator meticulously types William's exact words into the official claim file. When the corporate adjuster reviews the case 48 hours later, they immediately seize upon the verbal admission of a prior surgery. They formally classify the catastrophic ligament tear not as an acute, unforeseen accident, but as the direct aggravation of a pre-existing medical condition. Because William did not purchase a specific pre-existing condition waiver within 14 days of his initial trip deposit, his standard policy entirely excludes any claims related to historical injuries. The insurance company permanently denies the $25,000 claim for the Scottish mountain extraction and subsequent orthopedic surgery. They bypass the actual medical diagnosis from the Scottish doctors entirely, relying solely on William's own ill-advised speculation during that recorded phone call. This catastrophic potential outcome perfectly illustrates why you must rigidly adhere to a highly specific, legally defensive script the exact second the operator answers the phone. The absolute primary rule of the emergency assistance call is that you must never, under any circumstances, verbally speculate on the medical cause of your emergency, and you must never volunteer any historical medical context to the insurance operator. Your communication must be relentlessly factual, restricted entirely to your current geographic location, your immediate symptoms, and your demand for financial authorization. When the operator asks what happened, your response must be an impenetrable wall of current tense facts. You state exactly this: I have sustained an acute, unexpected injury to my leg. I am currently located at this specific hospital or GPS coordinate. I require an immediate case number and direct financial authorization for emergency medical treatment. If the operator attempts to probe deeper, perhaps utilizing conversational tactics to ask if the injury has been bothering you lately, or if you have a history of joint issues, you must deploy a strict verbal blockade. You clearly state, I am not a medical professional and I am fundamentally unqualified to diagnose the underlying physical mechanics of this acute injury. I will explicitly instruct the attending foreign physician to provide your corporate medical director with a comprehensive clinical report detailing the nature of this unforeseen emergency. By stating this, you legally transfer the entire burden of diagnostic proof away from your panicked, recorded voice and directly onto the credentialed medical professionals. You completely strip the claims adjuster of the verbal ammunition they desperately need to categorize your emergency as a pre-existing condition. Furthermore, you must exercise extreme psychological discipline regarding the intoxication exclusion we analyzed earlier in this masterclass. Historical trends in claims auditing reveal that intake coordinators are specifically trained to casually ask what you were doing immediately prior to an accident. If you casually mention that you were walking back to your hotel after enjoying a beautiful wine tasting tour, or that you slipped by the pool after having a quick drink at the swim-up bar, you have just instantly activated a mandatory internal toxicology investigation. Your script must remain surgically precise. If asked what you were doing before you fell, you state simply, I was walking to my hotel or I was walking near the pool. You provide zero atmospheric details, zero timeline context regarding meals or beverages, and zero conversational filler. You treat the call exactly like a structured legal interview where brevity is your absolute greatest defensive weapon. Once you have established the strict boundaries of the conversation and successfully secured your official claim number, you must immediately transition to establishing an undeniable paper trail. The very last question you ask the intake coordinator before hanging up the phone must be a demand for the direct email address of the specific department handling your newly opened file. The exact minute you disconnect the call, you must open your smartphone and draft a highly formal email to that address. You reference your specific claim number in the subject line, and you explicitly state that you are officially invoking your primary medical coverage, or your hospital of choice rider, or whatever specific premium benefit applies to your situation. You demand written confirmation that they have initiated contact with the foreign hospital's billing department to establish a direct guarantee of payment. This immediate written follow-up permanently locks the insurance company into a timeline and prevents them from legally claiming they were entirely unaware of the severity of your request. This masterclass has systematically dismantled the heavily marketed, deeply misunderstood facade of the global travel insurance industry. We have moved far beyond the glossy brochures and entirely exposed the ruthless algorithmic mechanics of how international risk is evaluated, shifted, and frequently denied. You now possess the forensic understanding that travel insurance is not a benevolent safety net designed to automatically catch you when you fall. It is a highly complex, rigidly defined financial contract governed by microscopic chronological windows, massive medical exclusion clauses, and aggressive actuarial depreciation formulas. You now fully understand the devastating financial differences between primary and secondary medical coverage, and exactly why secondary policies can bankrupt you in a foreign emergency room while you wait months for domestic claim denials. You have learned how to expertly navigate the treacherous chronological traps of the cancel for any reason upgrade, realizing that failing to insure exactly 100% of your non-refundable costs, down to the very last dollar, will instantly void your premium protection. You now know exactly how to legally force an underwriter to deploy a multi-million-dollar air ambulance by securing highly specific, aggressive written documentation from the local foreign physician proving that remaining in the current facility constitutes an imminent threat to your survival. You understand the profound value of the hospital of choice rider, the only contractual mechanism that guarantees your immediate return to the United States for advanced medical care. You have recognized the severe geographic and third-party liability exclusions hidden within your premium credit card rental car benefits. And you now know exactly how actual cash value depreciation legally reduces your stolen multi-thousand-dollar laptop to a few $100s. Most importantly, you now hold the precise psychological strategies and exact verbal scripts required to survive the terrifying, high-stakes emergency assistance phone call without unknowingly providing the insurance adjusters with the exact verbal confessions they need to permanently deny your claim. You are no longer operating on blind faith or dangerous assumptions. You are operating with the cold, calculated precision of an educated consumer who understands exactly how to legally enforce the expensive contracts they purchase. You now possess the power to step onto an international flight knowing that your financial architecture is genuinely impenetrable. But while you have successfully mastered the incredibly complex world of international travel insurance, there is another massive, completely unregulated industry actively preying on United States citizens every single day. What happens when the disaster is not a broken leg in Europe, but a completely frozen, unrecoverable bank account while you are standing at a foreign checkout counter, simply because an automated algorithm falsely flagged your perfectly legal travel behavior as an international money laundering operation? The hidden world of digital banking freezes and algorithm-based financial ruin is terrifying, and it is exactly what we will expose in our next investigation.